In this video, we see the refinement zones and how you have to map out the chart in higher time frame as well as in lower time frame. This was the first scenario. Price is coming from the upward direction and here he makes an inside bar, and after that again price going into the downward direction. These three candles are formed in the HTF, or you can say that higher time frame. So consider, for example, this is the scene of 4 hour. In 4 hour you can see that there is an bearish candle, after that an inside bar, and after that again an bearish candle. In 4 hour this is the biggest bearish candle. Again after that it forms the inside bar, and after that again price just break this zone and again it makes a bearish candle. So the inside bar which you see on higher time frame, that is the range in the lower time frame, right? If you see an inside bar in a 4-hour chart, then that means in a 15-minute chart there is a range forming exactly at this point. Here you can see that a sudden move in the downward direction. So what is our next target? If the price is coming back in a rounded return or corrective return, then again from the fair value we just go into the downward direction. So this is the first model. This is the higher time frame model and how you can trade on higher time frame model. So you have to just remember that the inside bar which is forming after bearish candle, and again the price is going into downward direction with the heavy injection of sellers. So you have to know that the inside bar in the 4-hour time frame or a higher time frame, it's a range in the 15-minute or the lower time frame, right? So this is the continuation model. You can see that price is coming from the upward direction and again it going in the downward direction. So this is the continuation model, right? Same from the demand side. You can see that there is a large bullish candle, after that an bearish small candle, or you can say that an inside bar. After that price just break this zone, or you can say buyer's injection forming exactly at this point. So this inside bar is in a lower time frame. It makes a range. Here you can find out the range in a lower time frame, or you can say that in the 15-minute. So this is the range created demand continuation model. You can see that price is coming from the downward direction. It makes a small pause in higher time frame, but in lower time frame you find out this as a range, right? So this is the continuation model. Now we discuss about what the higher time frame looks like when there is a small shadow on the upper side and small shadow on the lower side. This is the continuation model. If you find the two heavy candles in a continuation trend, then you can trade after the correction or rounded return. You can place a trade exactly at this point in the downward direction. The first candle lower low and the second candle's higher high, it makes a zone, right? That makes a pivot in a continuation way, right? You have to just wait for the price return back to the zone, and after that you can make a trade in the downward direction. So this is again the continuation model in higher time frame. Same from the opposite side. This is the heavy candle which forming a high and the second candle which forming a low. So if you find any healthy two candles in the higher time frame, you can see there is a two healthy candles and the wick is relatively small. Again the wick is relatively small. Then this is the continuation pattern in higher time frame. In lower time frame you just find out this is pivot. After it forming higher high, you see that there is a sharp move in the downward direction and again true expansion in the upward direction. If the price is written back in a corrective or rounded return, then you can see that from the fair value you can again place a trade in the upward direction. So this is again a continuation model in the higher time frame. Now the next model is, if the wick is relatively small, now you have to consider if it is a continuation trend, or you can also trade on the reversal trend. If the price is coming from the downward direction, then this can be also a reversal trend, right? If it from the upside and again it makes pivot, then this is also a continuation model. Now we discuss if the wick is relatively small. You can see that the wick of the bullish pin bar is relatively small, and after that you can find a heavy volume from the supply zone. So price creates a supply zone. You can see that a small bearish pin bar candle and the wick is relatively too small. So now you have to consider the whole candle. You have to consider the whole bullish candle. And again you see that price just breaks this zone in the lower direction with the heavy volume. So you have to wait for price just return back to this zone and after from the fair value, price is again moving in the downward direction. So that is the scenario when the wick is relatively too small, right? Use the entire candle and wick to map out the zone, right? Same from the opposite side. Here you can see that there is a bearish spin bar, or you have to just see that the wick of the bearish body is relatively too small. So this sharp move in the downward direction through expansion in the upward direction, you have to consider the whole candle, not only the wick. You have to consider the entire candle to map out the zone, right? So after break, price is moving in the upward direction. Now you have to wait for price is return back in a rounded return or a corrective return. Then from the fair value, you can go again in the bias direction. There is again a trade from the demand area. Now we see if the wick is relatively large, then what you have to do? So if the wick is relatively large, you have to just map out only a wick, because this wick in a lower time frame, it shows the price action looks like this. You can see that what is this price action. So it makes a pivot in a lower time frame. So you have to just map out the wick only, right? Because it looks in a lower time frame, the sharp move in the upward direction and true expansion in the downward direction, that is our pivot. So price is coming back in a upward direction. From the fair value, price is again going in the downward direction. So this is the scene in a seller's market, or you can see that this is the scene on the supply area. Now same from the demand side. If you find any wick, this is the bearish candle, and if you find any wick which is larger than the body, or the wick is relatively too large, use the entire wick to map out the zone, because this wick looks like this. You can find that there is a sharp move in the downward direction through expansion in the upward direction. This is the scene in the 15-minute time frame, for example, and this scene is, you can find, is in a 4-hour. So this is our 4-hour scene, and this is our 15-minute. So how this wick looks like in a 15-minute, you can see here. So in 4-hour, you see that any wick which is relatively too large, then use the entire wick to forming the zone, right? So this is the scene for the trade in the demand area. So this is the important models in our SMC course, which is helpful to make a trade with a high probability in the market.